page of.
It says it's now streaming live on Facebook on my side.
Cool. All right. And it looks like we are live. All right. I'm so excited to be with you again for another episode of Wealth Matters for Financial Dominion. I'm excited about our guest this week and so grateful for his time. Most of you know by now that Wealth Matters started this year in the midst of coronavirus out of a prompting and a sense of urgency that we are going to need wealth like never before if we want to give extravagantly, spread good news. We're going to have the resources to do so. And so we want to be like the sons of Issachar who have understanding of the times that we are in. If we want to share good news, we can't just walk up to people and say God is good. When they don't have the money to bury their loved ones, they're suffering from all kinds of situations. We want to be able to pour resources into what they're going through. And so that means we need to educate ourselves and position ourselves to build wealth like never before. And this week we have with us Jeremy Schneider, who is the founder of Personal Finance Club and just so generous with his gifts and giving back in this financial literacy arena. And so I'm happy to have him on the show. Jeremy, welcome to the show.
Hi, thanks for having me.
Oh, it's great to have you. So in the past few weeks, we have been talking about wealth building. We've been talking about getting out of debt. And this week, I want you to share your story because I'm sure people are excited to know, how did this guy retire at 36? Who is this guy? So I'm sure they want to know how you did it. Could you share a little bit about your story and your background?
Sure. So I was a kid in college. I was on the track team and I was graduating, and instead of getting a job, I decided to start a company. And so it was kind of like my last year of college, and I started an internet company. And for years it was a mess. I didn't know what I was doing, and I just basically didn't quit, and I kept trying to figure it out and take it one day at a time and keep improving. And I actually acquired some debt during the first couple of years. I think my first full year in business, I made $14,000 was our top line revenue minus expenses. Everything that was left over is what I got to like live on, which was, not enough to even eat. So I was basically living on a credit card for that year. Then the next year, I think I spent $10,000 in credit card debt. And then the next year went up to 12,000. And then by the third year, I basically had enough revenue to cut both me and my partner, who was my mom at the time, checks for $12,000 each. And so I was able to pay off my credit card debt in one check, which was nice. And then, that was 3 years in, which sounds really fast when you're giving the 10-second overview. But at the time, it was a grind, right? It was 3 years of my life where I was just trying to not live on credit cards. And then fast forward another 7 years, or I think it was 12 years total. 2005, we were making about $1 million a year in revenue. And then I sold the company for just over $5 million. And so after 12 years of pretty hard work and grinding, and during that entire time, I never paid myself more than $36,000 a year. That was my
Wait. I have to stop you there.
Yeah.
I want to make sure people heard what you just said. You said that whole time you never paid yourself more than $36,000 a year. That's pretty phenomenal. And then also we have people who watch and listen who are aspiring entrepreneurs. So the fact that you came out of college, started a business, and you admit you didn't know what you were doing. You just kept working at it. I think that's something to highlight. I mean, would you do it differently now?
Yeah.
Knowing what you know now?
When I tell my story, I hesitate to be like, this is the blueprint, because it's definitely not the blueprint. It's not how you should do it, and it's not the best way to do it. But I think that the same things that work for me work for basically everybody. Things like persistence and improvement and figuring, entrepreneurs are naturally not necessarily super great at any one thing, but they figure stuff out. And so when I didn't know what I was doing, I think what made me at least a decent enough entrepreneur to have this success was that I didn't give up. And when something new and confusing came along, I didn't run. I was like, okay, well, now I have to figure this out, and now I have to figure this out. And so after years of that kind of figuring out different types of parts of the business, whether it's marketing or hiring people or selling something or cold calling or emailing or technology or websites or whatever, you just figure these things out one at a time, and over a long period of time of persistence, you have a lot of success. And so I think that's the real lesson to take away, not that like you have to start a company in college and flounder for several years or whatever.
But yeah, so I've heard parts of your story. So you started that company, and that company, if you could explain, I know that it had something to do with helping landlords publicize, their properties. Can you just briefly explain what that company was and how you ended up selling it, like how you got people interested in it?
Sure. So if you're a renter looking for an apartment, you could go to Craigslist or Zillow or apartments.com or Apartment Guide. There's like 50 of these different sites. But then landlords have this problem, which is how do you post to 50 different sites, keep your listing updated, and keep the rent accurate and all that stuff. And so I made a site where you could post once and automatically syndicate to 50 different sites. And so it's basically a tool for landlords. Like what I just described in that few seconds took me a long time to figure out. It wasn't just like I was a 21-year-old college kid be like, there needs to be a rental housing syndication service. It was like, I made a website and then that was kind of crappy. And I sold it up to someone else. So it was a little better. And he was a landlord. He's like, got this problem. And over years, I kind of figured it out. And then, and so then we were growing, and we found what we call product market fit. Like we were selling this thing that people actually wanted, which was great and made business a lot easier. And then a company came along, which basically needed to do the same thing. The company's called Appfolio. This is like a matter of public record now. And they, basically saw what we were doing and decided it was very hard to do, to create what we had worked for 12 years to build. And so instead of trying to build it from scratch or compete with us, they just decided to buy us. And in terms of like how we found them, it was lucky, but I think a lot of business is just putting yourself in a position to get lucky over and over and over. And then one of these times you get lucky and you're like, oh, that was nice. And so, I think several other companies could have bought us because we had a lot of value to what we were doing. But with them, we actually emailed them to suggest a partnership because I was trying to grow the business and saying, I basically offered our services to them for free and said, hey, they have a bunch of customers with a bunch of data, like apartment listings that we could send to these websites. I said, hey, can we do that for you for free? And they said, we don't like that idea because we don't like partnerships, but we'll just buy you instead. And I was like, okay.
Now, you offered a service for free. And this is part of what I really liked about what you were doing when I discovered Personal Finance Club. You've continued that pattern. Like you're offering all of this financial information for free on your Instagram account. You're just giving it out. So when you had that pattern, right, where you went and you said, hey, we want to partner with you. We'll give you all this tech. We'll give it to you for free if we can just be your partner and position ourselves to have this data. But the thing is, you didn't go in. I don't think you went in and said, buy us. You went in and said, let me be a partner. Right.
I mean, to my own discredit, I didn't really see them as I actually thought that Zillow or apartments.com or realtor.com were going to buy us because we had all this data. And so in the process of positioning ourselves to get acquired by one of those companies, I was collecting more data. And I didn't see Appfolio as a potential acquiring company. I just basically wanted their data and was willing to trade the service for free. And I guess the whole giving, even the basic service we used to provide was free, and then there's upgrades. I guess I've always just had kind of like a long-term view, which is I don't try to squeeze water from the rock, as they say. Like if you have like a little, like if I had 5 Instagram followers and I was like, oh, you guys got to pay me something, it's just like, you're just going to annoy them and you're not going to give them any benefit and you're not going to get much from yourself. I'd rather just give as much as possible for free. And then when, you're rapidly successful because everyone loves what you're doing, then you can just charge for a little tiny piece of it and make a great living. And so, I guess I always think long-term in that way. Like I always project things like if in 10 years, like I had 10 million Instagram followers, everyone was copying me and stealing from me. And, if the thing happened that where I gave it all for free and like it just, the wheels came off because it started going so fast, that would be great,
Yeah.
because I could like make a living giving speeches or, like whatever, So, I always try to go towards that long-term path rather than be short-sighted and just try to like make a quick money grab.
And that's a great, great perspective. Long term, long term. And long term perspective is necessary both for getting out of debt, living below your means, and investing. So let's start to talk about some of that stuff. I just love your story. But let's start to talk about some of that stuff. Okay, so you got us to the point where you sold your company for $5 million. Had you been investing before
Yes.
that?
So yeah, again, like this, my story isn't the blueprint. Like, you don't have to go out and sell a company for $5 million, although that was nice.
That
But
was really
even,
nice.
yeah, I know. But even without that piece, so like I had said, I'd never paid myself more than $36,000 a year. For the 5 years before I sold the company, I was living in San Diego, which is a very high cost of living. And I was building wealth. And so like my net worth, ignoring the value of the company, before I sold my company, was a little over $100,000. So it wasn't, I wasn't a millionaire, but for a guy living in an expensive cost of living city, making, not that much over the poverty line, I had grown $100,000 of wealth. And the way I did that was basically just spending a little less than I made over the previous 10 years. And so, every year I made 36,000. I basically spent 31,000 or so and invested 5,000. 5,000 bucks a month times 10 years is 50,000. But that wasn't just sitting there under my mattress, it was invested. And over the course of 10 years in the stock market, money about doubles or so. And so right there is where my $100,000 came from, just that 5,000 a month, or 5,000 a year, sorry.
Yeah.
And if you project that going forward, if I did that for a couple more decades, I would have been a millionaire on my $36,000 salary. And so when you say think long-term, it's so important, because I think one of the biggest mistakes I see in personal finance is people who think money should be this get rich quick thing, or like, oh, I just need to, I need to double my money by this weekend, or and they see stories sometimes like mine where like, oh, this guy made 5 million overnight. I was like, I didn't make 5 million overnight. I made 5 million over 12 years of grinding and making very little.
There
And
you
then
go.
it happened to be a payday at the end of that. But for 12 years, I was thinking, a decade down the road, and I was 2 years late because it took 12, not 10. And so even without, even without the sale of the company, that early and invest in off early. And, so Personal Finance Club has 2 rules, which is to live below your means, spend less money than you make. And with the difference, rule number 2 is invest early and often. And so those 2 things is like personal finance in a nutshell. If you don't do those 2 things, you're broke. And if you do those 2 things, if you spend less than you make and you invest early and often, then you will build great wealth, even if you're not doing it perfectly, right? And so I always like to keep things real with those 2 things, because people get so confused about, there's like mortgage rates and interest rates and refinances and debt and Roth IRAs and yields and bonds and stocks, it can be so crazy when you take a step into that world for the first time. But just remember, you spend less than you make, you invest the difference, you'll be wealthy.
Now, I think that I love your 2 rules, and I've been eating up Personal Finance Club for the past week, so I love those 2 rules. And one of the things that I also love, I saw that you didn't buy a new car or a new home until you became a millionaire. So, I mean, a lot of times people will see, oh, he sold his company for 5 million. He must be driving a Bentley. He must be, living in, I don't know, 8,000 square foot home. But during that time, those 12 years, and I think throughout your journey, what I saw is that those things were not priority for you. I think you even lived in like a 1-bedroom apartment or something.
Yeah, well, for most of my time, like I was the boss of this company. I had employees, and I had a 2-bedroom apartment with a roommate. My rent was $700 a month in San Diego, which was great. We
That's
found a great
unheard
deal.
of in San Diego.
Yeah, that was more like 8 years ago or something. So prices have gone up since then, but still, it was a great price back then too. And yeah, I drove a '99 Ford Explorer, and then even when I paid for that '99 Ford Explorer, I paid $3,000 for in cash. And it sounds like, even when I hear myself saying it, sounds like, oh, you were trying to like be this person. I was like, no, I wasn't. Back then I wasn't into personal finance. I was just, I was frugal, but I just basically didn't want to be broke, right? And so when I bought that car in cash, it's because I didn't want to have a car payment. And actually before my 99 Ford Explorer, I had a 99 Mustang, which I did borrow money for. And I didn't like having it. It was so stupid. If I bought this car, which just became a crappy car very quickly because that's what cars do, and I was still paying like $400 a month for it for like 4 years or something. Like, and I'm like, man, that like car payment sucked. And so I sold that car and then I just bought a car in cash. And then for 6 years I drove it, no car payment. You know, stuff broke occasionally. You take it to the mechanic and he says it's going to be $500 and he fixes it. That happened like once a year or so. And so like my, you know, maintenance cost was like $40 a month if you average that out.
Mm-hmm.
And $40 a month is way less than a new car payment, which is like $500 or $600 a month on average. And so a lot of people say, oh, I don't want to have to deal with car problems, but like $600 a month versus $40 a month, you know, it's worth it. It's worth like once a year, you know, doing an errand is essentially what it amounts to. So I think it's just kind of an excuse people make because they just do what's, you know, not to acutely blame them, but I think people are like, you know, constantly seeing car ads and constantly like getting like just this marketing message like pounded into your brain. It's on TV, it's on billboards, like you see them driving around, like everything. But like it just doesn't matter. They're all used cars once they drive off on the lot. And then, you know, you don't need to ruin your financial future for this car. Sorry, I went on a rant there. What were we talking
No,
about?
it's really, really good. It's really, really good. Let me tell you why. Because you probably already know this, but the average net worth of an African-American home is $17,000, while the average net worth of homes of other ethnicities is like $170,000, 10 times. And a lot of where the debt is going is car notes. A lot of where the debt is going in African-American homes is car notes and student loans.
Yeah.
So what you just said is so profound. Like you don't need a new car.
Yeah.
You could take that $500 a month, even if you invest half of that,
Yeah.
500 a month, you'll be in a better situation than paying for a car note when you could get a good used car.
Yeah, let me tell you a little story. So the average new car payment in the US today is about $550 per month. And that's average. So, you know, half of people are paying more than that. But let's say $550. If instead of giving that to the car loan company every day for your whole career, you invested it just at like a 7% rate of return, which is about average over the course of the stock market, over an average career of 40 years, that car payment turns into $3 million. So your car payment alone is like the difference between being a millionaire and being a broke person.
Oh my goodness.
Yeah, it's crazy. And so, and you said, you know, and you don't have to invest all of it. You know, if you take $250 a month, so you take half of it per year, that's about, so 2,500, that's about 3,000 per year. And so over 3 years, it's about 9,000. So that means every three years, you have $9,000. If you just take half of that you could put towards a new car. So you could be buying, you know, once you do the math as it adds up, you could be buying new cars every 3 years for like $15,000 because it goes down in value a little bit. You put your new $9,000 in, you buy a new car. So you can basically be buying new cars, like great new cars, if you don't get into this trap of just borrowing money first and just plowing money to that payment. Right? So you take that $250 a month, you buy a very cheap car first, and then as you build up your car fund, then you move up in car over time. But then with the other $250, you invest, and then you're a millionaire. You're a millionaire over the course of your career, right? So like car payments are they just keep people broke. They're terrible.
So what did you buy? When you finally bought a quote unquote new car, what did you buy?
Yeah, so for a long time I bought nothing. I sold my, there's like a day where I refreshed my bank account. I actually have the video on my Instagram where it went from like $60,000, which is a lot, don't get me wrong, but 60,000 to like $2 million, like when I clicked refresh my browser. But then for almost a year, I think I just drove the same car because it was fine and I liked it. And it was getting old, and eventually I think I missed a flight because it broke down. And I was like, and a flight to like a business thing, and I was like, I need to show up to my work, because I was working now for the company that bought me and they were paying me a very healthy salary. And so I went out and bought a Mazda CX-5. I did buy it new, which even at the time I was like, oh God, I'm like one of these guys that buys new cars now, but I was like, whatever, I can afford it. And as a proportion of my net worth at that time, it was, not even 1% or whatever. And still, that was 4 years ago now, and I still drive that exact. I'm looking outside, and I almost point. I think I parked on the other side though. But yeah, it's still the car I drive today. Now it's a 4-year-old Mazda 6.5. It's great.
Gets you where you need to go, right?
Yeah.
That's it.
I think it still looks baller. I mean, and when people drive like you said, what'd you say, Aston Martin or Bentley or whatever, it's like, whatever. And more often than not, they're broke anyway. Like whenever I see a BMW, I'm like, no, that person just is leasing it, or they have a loan on that. That's not a rich person. That's just a person who's spending their money. There's a difference between having wealth and like spending wealth, right? Like,
yeah.
People who have wealth don't want to burn it on cars because cars are terrible investments.
Oh my gosh, would you say that again, please? Please.
Oh, it's true. Like I think more often than not, wealthy people will drive modest cars, will drive used cars, because cars are terrible investments. It's just a way to burn money. They plummet in value, and rich people drive modest cars. Yeah.
Wow. Okay. So, woo! Yes. Hand claps for Jeremy. Hand claps for Jeremy. All right. So, I just love that, because when I saw that, I was like, this guy didn't even buy a new car. Like, it just made me think that you understand money. I mean, most people who spend like that don't understand money, because, as you said, it's just not a good investment. So something you said, or one of your Instagram posts or something, you said, I can't remember what it is, but it'll come back to me. I think it was, a mortgage doesn't make you rich, or owning a home doesn't make you rich, or something like that. Yeah. And so it was just challenging the way that people think about the American dream. Like everybody wants to be a homeowner. And I think you did a calculation of the expenses on your home, and it came up negative. Yeah. Not that you're against having a home, but you talked about the fact that there's a difference between being a homeowner and being a real estate investor, or renting out a property. Yeah. Can you talk a little bit about that? Because I think a lot of times people are trapped by this American dream that I got to have a nice house and I got to have a nice car, when actually it's working against them.
Totally. And so first of all, thank you for not accusing me of saying everyone should always rent all the time, because that's not my position. But whenever I suggest, like even the mere suggestion that home ownership carries expenses, people are like, well, renting's not better. I was like, whoa, 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 whoa. I didn't make a blanket statement that people should always rent. I said, hey, you should go into homeownership with your eyes wide open. And so I think you're right. I think just like we all are, this messaging of you have to drive a fancy car is baked into us at all times, which is wrong. It's a way to like burn money, not to like be wealthy. Mm-hmm. The same thing is true for homeownership, which is, I think a lot of people think that you should buy a home at all costs. It's the best investment you'll ever make. You should like plow most of your money into your home, and like those things are not true. And the reason that's true is because homeownership is expensive. So, when you look at your mortgage payment, first of all, your mortgage payment is only about half of your expenses. So mortgage payment is going to the bank to pay interest, and then a portion of it's going to principal. And if you look at how much goes to which, most of it goes to the bank for most of the early years. And people usually sell the home at that point and then go get a different mortgage. And so when you're paying, let's say $1,000 a month, usually like $700 or $800 of that is just going to the bank. It's just getting burned. And then $200 is going towards principal. Mm-hmm. But on top of that $1,000, you have another $1,000 of expenses, which are property tax, which the government's going to get a piece of that, property insurance, which you have to pay if you're a homeowner, realtor fees, which you have to pay when you buy and sell properties, mm-hmm. and maintenance, which people like to ignore. But then they do a bathroom remodel that's $10,000, and they own the place for only 5 years or whatever, and you average that out, and now it's another $500 a month that you paid for that bathroom, which you now are selling, and didn't really have a meaningful impact on the sale value of the home. And so when you look at that $2,000 a month you're spending, and only $200 is going towards principal, that $1,800 is just getting burned in the same way that rent is. And so when people say, oh, I pay $2,000, but at least it's an investment, I was like, well, if you paid $1,000 for rent in a more modest apartment and you were investing the other $1,000, you would be investing 5 times as much money, because instead of $200 going towards a house, you'd have $1,000, 5 times more, going towards investments. And the kicker is, homes don't go up that much in value. They go up about 4% per year over long periods of time. Mm-hmm. And so, people think they go up a lot in value because they see those in like real terms, because it's something you have to buy, but it goes up way less than investments like the stock market or investment real estate, which includes incoming rent, right? So when you are thinking about where to put your money, you want to put your money in things that go up in value quickly over long periods of time, like the stock market and investment real estate, not things that go up slowly, like the home you're living in with all these additional expenses.
Yeah, I think that's a wonderful, wonderful explanation. So what that says to me is that we shouldn't buy a home, our primary residence, a home that would be our primary residence. We shouldn't buy beyond our means. We may want to even think about buying a little bit under our means, and focus on eventually having those investment properties instead of trying to impress everybody with your nice big house, like, which we really don't care anyway. Do something different.
Nobody cares what you have. They'll probably like you more if your house looks worse, so they feel better about themselves. But you know,
And
whether
you
you
flip
rent
houses,
or
don't you? You flip houses, right?
so yeah. So I over the last after I had my windfall with some of my company, then I started investing in index funds and investment real estate. It's the two things that I think anyone should invest in. I think everything else is basically nonsense. It's different shades of nonsense, which I could go into, but building
Different shades of nonsense.
yeah.
And you don't believe in investing in gold, do you?
Nope.
Which is another misconception in the African American community. Like, everybody's like, invest in gold, invest in gold, invest in gold. Can you tell us why you don't believe investing in gold?
So investments are something that should be paying you money, that should be having a stream of income. And so if you buy an index fund, that's basically buying the entire stock market. You've got 4,000 US companies constantly pumping money back into your account, which is great. And if you buy investment real estate, you have renters paying you a lot of money, pumping money back into your account. And the longer you hold those things, the more cumulative effect that has of building that wealth. If you own gold, you own a rock, and it sits there, and you speculate one day that someone will pay you more than you paid for it, hopefully. But there is no this cumulative compound growth effect of the money creating more money, creating more money, creating more money. It's just speculating on the future value of a rock. And so, I don't know if gold is going to go up or down. I don't know if oil is going to go up or down. I don't know if pork bellies are going to go up or down. But I do know none of those things are going to create new income. They're not going to innovate. They're not going to be paying me money a long time. And so, when you look at the history of gold, the numbers back that up. So over the history, if you look at the last 100 years of gold, I actually paid $4 the other day to get the gold prices going back to like 1915 or something like that. So it's actually 105 years. And if you look at that history, the gold price has gone up about 4% per year on average, about the same amount as homes, by the way. But inflation is a real thing, right? So things cost more money too. So inflation is about 3% per year on average. And so when you look at the value of gold relative to inflation, it's only got 1%, which means if you had a bar of gold in 1915 and a bar of gold now, they both would buy about the same amount of stuff. They'd both buy about the same amount of food. So if you're putting all your money into gold and letting it sit there, you're just basically saving your money, which is okay. It's not bad, but it's not, you need to be outpacing inflation if you want to build wealth. Yeah. So here, let me see if I can find this. I think it's one of my recent posts. It's like so good because like the value of gold, like I think it's like $100 in gold over that 100 years is now worth $400. $100 in index funds is worth like $100,000.
Oh
like,
my goodness.
The difference is like monumental, right? And so why, if I wasn't going to own it for 100 years, why would I own it for 1 year? Because I don't know what's going to happen. And so I don't speculate. I just buy the sure things that pay me money.
So for everyone to be on the same page, can you just give us a baseline definition of an index fund, so we make sure everybody knows what an index fund is?
Yes, I know that those words can be like scary and confusing, and they are to me too. And I have a simple mind, so I like to break things down simply. But basically, a stock is when you buy a small piece of a company. And so back in the day, before computers and stuff, you would go to an office of a stockbroker and you would say, I would like to buy one purchase of like the American Steel Company. And so he would like, find someone who had a share and then make that transaction happen, take your money and then give you like a piece of paper that says one share American Steel Company. Then you would hold it. They would pay you dividends when the American Steel Company had profits. They would pay you dividends, which would come as like cash back to you, which still happens today. So when you own a share of Apple, for a more modern example, Apple pays dividends every quarter. And so if I own one share of Apple in my account, like my bank account there, like every quarter, new money just gets deposited in that account just for holding that share of Apple, which is great. But then the question is, okay, which stocks do I buy? Because there's a lot of stocks. And I think this is where people kind of get like wrapped up in, new investors like, ooh, like Apple or Beyond Meat or Tesla. And so they hear things, they've got hunches, or they read an article or whatever. But the problem is with picking and choosing stocks, it's basically impossible to consistently pick stocks that beat the market over long periods of time. Because when you or me or anyone else who has one person's perspective is picking and choosing stocks, we don't have access to the sum total of human knowledge that is constantly being priced into the stock market. Every single stock in the market is what's called efficiently priced, because every single day it's trading pennies. Like computers are doing this millions of times a second, like trading, and so the prices are going up a penny. You can look at it on the stock charts where every single minute the prices are going up or down by pennies. It's because it's like the sum total of human knowledge is constantly being priced in. So if I look at that and say, oh, that price is way too low, it's actually far off, Apple is worth much more than that, I'm just wrong. I'm just full of it if I say that.
Yeah.
So then the problem is, okay, if I don't know which stocks are underpriced that I should be buying, which ones do I buy? The answer, it turns out, when you read study after study after study, is you should buy every single stock. It sounds a little bit crazy the first time you hear it, but it turns out that since every single stock is efficiently priced and accurately, maybe not accurately is the right word, but efficiently priced, then the only thing you can do to improve your own future like wealth and benefit is to minimize volatility. And so if I just buy the American Steel Corporation, for example, and then steel suddenly isn't worth as much because plastic becomes a thing and technology becomes a thing, then I'll have done bad. And at the time it seemed like a great idea because, steel's, railroads and steel's gonna last forever. But then
or gold is going to last forever.
Or gold or whatever. But but since we're just speculating, but we don't know what the future holds because things change. Like Facebook wasn't invented, and the people who bought the American Steel Company didn't realize Facebook was going to be invented. But if you buy every stock, you guarantee your fair share of all market growth. So to answer your question, an index fund is a simple one little thing you could purchase. It's on a website. There's a button you can click, and then you buy the entire stock market, and it guarantees you your fair share of market growth. So an Apple and Amazon and Facebook and ExxonMobil and Google and all the other companies in the economy are profiting and building wealth. They're funneling that money back into the index fund, into your account. And just by sitting there and doing nothing and holding the index fund, you are building real long-term wealth.
Wonderful. So was this always your go-to, or how did you hone in on index funds?
So index funds they were created by a guy named Jack Bogle back in the 70s. I think 75 was the first index fund. And, he was kind of ostracized at the time for the notion that you should buy every stock, because all the smart stockbrokers, who, by the way, made a lot of money by trading these paper shares of stocks and eventually digital shares of stocks, said, hey, Jack, if you make it that easy, we won't be able to shave all this money off the top of the market and then only return what's left over to the investors. And Jack's like, I don't care. Like, I'm going to prioritize the benefit of the individual investor over the benefit of Wall Street, who makes money by shaving money at the top. And so, Wall Street didn't like him. And for years, and Wall Street had a good pitch to investors, which is like, oh, we're smart. We know the good stocks, pay us and we'll buy the good stocks for you. But time has proven that Jack was right. And buying the index funds is the right way. So so when I was a kid, my 20s, like they weren't as popular. And then especially after I had my windfall, I basically started reading every book I could get my hands on personal finance and investing. And they all say the same thing. They literally all say the same thing. And it's not like what you hear when you're at a dinner party or at Thanksgiving and you got a stock tip, or like I watch YouTube and there's all these like sleazy stock guys like, you can make 2,000% in a week. And it's like all nonsense garbage. And the reason you don't hear the real message, like I'm telling you now, is because I'm not making any money doing it. I'm not paying ads to go on YouTube to say this, because there's no money to be made in index funds except to the individual investor. Yes. Whereas the guys telling you all these stock tips, they're the ones making the money, not you, right? And so, I basically found this from my own personal journey of experience and reading all the classic books on investing, which point you to this exact thing.
Point you to the exact same. So one other thing that I've learned and also, just from looking at some of your stuff, the fees on the index funds are drastically lower than anything else. And then you also had something where you said, was it Warren Buffett who said, I'm going to put all my money in index funds?
Yep.
And like he outperformed all the other people that were given all this other advice. There was like, was it over a space of what, 10 years? I don't know, but there's something you have about Warren Buffett talking about index funds. Can you tell us about that?
Yeah. So Warren Buffett is one of the most prolific and successful investors in history. He's the CEO and chairman of Berkshire Hathaway, which is like a conglomerate that owns like tons of companies, including like Geico Insurance and See's Candy and like all these companies heard of. Like he basically owns all these companies because he's this like amazing investor and he's one of the few people in history who like can pick stocks that outperform the market through like diligent hard work and analyzing the companies, whatever. But he basically says, even me, like, it's very hard to beat the market. And even me, I don't know if I can do it going forward. But all these other people say they can. And so he said, okay. And so there's this thing called a hedge fund, which is basically just a bunch of money that's collected from rich people. And then these Wall Street guys take all that money and invest it for the rich guys and then return the value minus their hefty fee.
Mm-hmm.
And Warren Buffett says, okay, hedge funds, if you're so smart, let's make a deal. Let's make a bet. For the next 10 years, I'm going to buy an S&P 500 index fund. I'm going to buy the simplest thing you can buy. It's like the cost is pennies. I'm just going to put my money in. I'm not going to look at it. I'm going to make one transaction ever, just a buy at the beginning of 10 years and do nothing else. You guys can do whatever you want. You can day trade pork bellies. You can short sell. You can do options. You can do reverse options. You can do triple leverage reverse options. You can do whatever you want. You can make it as complicated as you want. Go nuts. Have a field day. See in 10 years, like loser has to pay $1 million to charity or whatever the bet was. I think it was like literally $1 million bet. So 10 years later, the hedge funds had an average return of like 2.5%. I might be off by a couple tenths. They had like a 2% return, and the index fund had a return of 7.7%. So it got crushed. Like, and that's per year. And when you extrapolate that over time, like it just got crushed. And like Warren Buffett's like, yeah, see, you guys are full of it. You just take all this fees. You can't beat the market because no one can, because you're just trying to you're competing with other people who are trying to beat the market and all shaving money at the top and all losing. Meanwhile, if you just ride the wave at the top of the market, then you can have better returns. So yeah, even Warren Buffett says so.
I don't think you could go wrong with that advice. With that illustration, I just don't think you can go wrong. I'm going to ask those that are watching online if they have any questions for you. But while I do that, can you tell us some of the funds that you like? Are you Vanguard? Are you Fidelity? Like, are there certain funds that you like personally that you would recommend?
Jack Bogle, the founder of Vanguard and the inventor and popularizer of the index fund, created Vanguard kind of in his own image, not his image, but like in his ideals. And so if anyone wants to go with Vanguard, I always say, great, that's a great option. Vanguard has low fees. They're primarily focused on index funds. They actually have an interesting business model where their company is owned by the funds. So when you invest in the Vanguard's funds, you also own Vanguard itself. So what that means is they don't have an ulterior motive to funnel fees to external investors, which is unique in this space. So if anyone wants to go with Vanguard, that's great. That said, an index fund basically is an index fund. If you buy an S&P 500 index fund with Vanguard or with Fidelity or with Schwab or with iShares or with basically any provider, it's going to do virtually identically the same because it is the market and there's nothing really tricky happening underneath. And so, a lot of times if you have a 401k or you're overseas or you already have a Schwab account or, for various reasons, it might not be convenient or possible just to buy Vanguard funds. Okay. So you just look for an index fund. And, there's basically two ways I like to invest. One is what's called a 3-fund portfolio, which is buying a US index fund, an international index fund, and a bond index fund. And there's those 3 things. And if you go to my website, I hate to give the shout out, but I have a really simple article on 3-fund.
Please give a shout out. You have great stuff on, please.
Personal Finance Club.
You have great stuff on all of your platforms.
Yeah.
So please give a shout out. Tell them where they can find that.
Thank you. So yeah, if you go to personalfinanceclub.com and search 3-fund portfolio or 3 or anything like that, you'll see the actual ticker symbols based on your brokerage that you can buy. Or there's an even simpler way, which is those 3 funds can be wrapped into one package in what's called a target date index fund. And so these brokerages have made it even easier for us. And again, this is like the super duper low cost way to do it which maximizes your own wealth. But no one's advertising this stuff because there's no money to be made. There's no profit to be made for the companies, but they're there if you go look for them. And so if you go to my site and search target date index fund, it'll give you the ticker symbols. So you basically just type in the year of your retirement age. So your birth year plus 65. And then you look at the ticker symbol and then buy that. And so, yeah, I know that the logistics are confusing to people, but it's really not that hard. And I've got, walkthroughs on my Instagram and stuff where you can, just go to the website, you click open account, you type in the thing you want. It's really not that hard, though I admit it is daunting the first time you do it.
Great information. Listen, we just totally got off of our talking points, but it's been wonderful. And listen, you guys help me spread the word, because Jeremy has graciously agreed to come back next week. So we don't just have him for 1 week, we have him for 2 weeks. So spread the word. This is great information. Listen, you would have to pay for this information, but like I said, he's one of the few people that I've seen thus far in the industry that is just giving back. And I was talking with Jeremy before we came on live, and I said that there's some people that you just hate to listen to them because they're just so arrogant, right, in this space. But I have just found Jeremy to be refreshing. So I want you to make sure you go to his Instagram, go to his Facebook, go to his website, go to his YouTube, and support what he's doing. Listen, no, seriously, if you want to get this information, get it for somebody who's not trying to get rich off of it and is just giving it back, just because they want to see people be better. And I've seen that in Jeremy. So Jeremy, we're coming up on the end of our time for this week. So we just have some lightning round questions that we want to ask you. And then maybe next week we'll get to the checklist since we didn't go through that today. But there are a couple of questions we want to ask you, just lightning round questions. So the first one, what book have you read in the last 6 months to a year that you would recommend to those seeking financial freedom and wanting to invest wisely?
The Simple Path to Wealth by J.L. Collins. It's a really, really good book. It's like an easy read. He also is a fan of, I actually read this book relatively recently, embarrassingly, and as I was reading it, I was like, I'm a fraud. This is like, all I say is exactly what he's saying. And I was like, oh, I guess it's because it's just the right thing. And it's in all the other books on investing because it's the right thing. And so, but it's a really easy read. It's like, it's kind of written from the perspective of a father giving advice to his daughter. The Simple Path to Wealth. It's a great book. And yeah, if you read like that one book, it kind of like you wrap your head around why this is the right way to build wealth.
Wonderful. What do you see as the greatest challenge to financial literacy and wealth building, and why?
Yeah, I think just education is the answer. I was even thinking about this today, which is like, why don't we teach this in schools? And it's difficult because teachers don't know either. And so, we have like, decades and 100 years of an educational system where it's like we teach English and history and science and math, and those students become those teachers, but like there isn't a money track. And the teachers, sometimes, like I love teachers, like I think they're amazing people who devote their life to service and help the world, but they often suck in money, and because they don't know either. And so it's like, how do we move the world such that this is like a more mainstream, subject in schools? And I don't know, but I think it just starts, like any movement starts by like getting the word out and doing things incrementally, which is what I'm trying to do.
I think you'd be well positioned to do that. So yes. Okay. So next question, what leader in your industry is currently inspiring you and why?
Yeah, for this one, you gave me these questions ahead of time, by the way. So I didn't know I was going to talk that much about Jack Bogle, but for this one, I thought of Jack Bogle, who is the founder of Vanguard. He, when you read about this man, he's basically just like an altruistic guy who forewent, like he could, with his position, he could have made untold billions by just charging higher fees and doing the same thing everyone else is doing. But he just basically eschewed that wealth to like pass that value back to the individual investor. But not for him, we would probably be still in this place where you just have to pay tons of money to Wall Street in order to capitalize on the value of the stock market, but we don't. So, and sadly, Jack Bogle died like a few days after I created my Instagram account like last year. And so, don't know the man. I hope that he would agree with what I'm saying, and that I am not using his name in vain or anything. But I try to like pass on his words of wisdom, because I think he is, you know, an honorable figure in this space.
All right. Okay, so last question. It's amazing how time flies. I mean,
Yeah.
wow. Last question. Tell everybody.
Sorry, someone at my door.
Oh, okay. Are you good?
No, I'm good.
Okay. So tell everybody where they can find you and Personal Finance Club. All your platforms. Tell everybody where to go.
So yeah, it's Personal Finance Club. I'm an easy guy to find. Most of the magic happens on Instagram, but I also have a great website, and I have a new community too. So if you go to Personal Finance Club and you click community, you can ask questions or search questions asked by other people, and just get lots of great information. And you know, everything. I currently don't charge for anything. I think I will, just like I mentioned before, I'm going to give basically almost everything for free and charge for something very small, just to help further fund, you know, hiring of graphic designers and video editors and things like that. But for now, everything's free, so you don't have to be worried about getting sold just yet.
Well, I encourage everybody to jump on now, and to support, and then also support this podcast. I want to encourage you to support. Listen, when you talked about paying graphic designers and all that stuff, people don't realize that it takes time to do that. Like to put all of the stuff that you put on your Instagram page, you know, and for Wealth Matters to put up, you know, all the graphics and things that we post to try to encourage people to come hear this valuable information. It takes time. And
money.
you know, so yeah, so support Jeremy and support Wealth Matters. You can do that in very different ways. You can support us by CashApp, $PH Venmo is at Purpose House. And then you can go to our webpage at purposehouse.net/Wealth Matters. Listen, sow a seed for what you have received on today. Sow a seed. I'm just so excited that Jeremy's going to be back with us next week. So this time, mark your calendars. Put it on your calendar. Wealth Matters next Wednesday, 1 p.m. And we will see you on next week. Jeremy, thanks again so much. And we look forward to having you back on next week. If you have questions, you can go to personalfinance.com, go to community, post your question there, however you want to do it, but reach out and give all your likes and hearts on Instagram at Personal Finance Club. Is that right?
Yep.
Instagram at Personal Finance Club. Facebook is at Personal Finance Club. You're on YouTube too, right?
Yep.
And YouTube. So
easy to find.
All easy to find. And let me just say this before we go. He's got a great series of videos on YouTube called Broke to Buffett. Broke to Buffett. So go check those out. All right.
Thanks.
Bye. Bye, 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 bye.
Bye.
Love you
Thanks,
guys.
Abby.
See you next week, Wednesday, 1 p.m. Don't miss it. Thanks again, Jeremy.